All right, let's dive in. We're tackling The Intelligent Investor today,
The Benjamin Graham classic.
updated by Jason Zweig for the 5th edition. It's pretty much required reading.
If you're into value investing, yeah.
Absolutely. And we're going to see if its wisdom still holds up in our crazy 2025 market.
Well, Graham's ideas, they really do stay relevant even as the market, changes all around.
It's amazing how that works. So let's start with that story about the super investors of Graham and Doddsville.
Oh, yeah, that's a good one.
These were investors who they learned from Graham himself,
Right.
and then they just consistently beat the market.
Mm-hmm.
What was their secret? Some fancy algorithm,
No.
insider trading.
Nothing like that. They focused on this simple but powerful idea: buy businesses.
Businesses, not stocks.
Not stocks, exactly. They saw each stock as like a little piece of ownership in the company.
Okay.
And they did their research, very carefully to make sure they weren't overpaying.
So they were getting a deal.
Yeah, like a built-in discount. Graham called it the margin of safety.
So like buying $1 for 80 cents, but instead of $1, it's a company.
Exactly. It's a pretty smart strategy.
It does sound smart.
Yeah.
But does it still work now in 2025? I mean, we have so much information at our fingertips.
That's the question, isn't it? Graham actually thought about that. He believed that human nature, people being afraid or greedy,
Oh, yeah.
that would always create opportunities.
For those who can be disciplined?
You're disciplined investors, yeah. He said, let me see if I can remember it exactly. Ships will sail around the world,
Okay.
but the flat earth society will flourish.
Meaning, even with all the proof, some people will always believe what they want to believe.
When it comes to investing too, yeah.
They'll overpay for a hot stock or sell everything when they get scared, even if it doesn't make sense.
That's right. And those who keep a cool head, they can profit from that.
Yeah, the opportunities might look different than in Graham's time,
They do. They definitely do.
but the core idea is the same.
Buy low, sell high.
Exploit the gap between, what, price and value.
Price and value, that's it. But the ways that speculation happens, that's changed.
So back then, it was more about companies with, like, shaky finances?
Yeah, or uncertain prospects.
Graham called that old speculation.
Right. Like, let's take American Can and Pennsylvania Railroad back in the early 1900s.
Okay, what happened there?
American Can, the earnings were all over the place, didn't pay dividends.
Sounds risky.
Yeah, it was a speculative bet back then. Pennsylvania Railroad, now they had steady earnings, paid dividends consistently.
Okay, more reliable.
But their long-term future was uncertain.
I see. That's a tough call.
Yeah, it was. And ironically, American Can, even with all that volatility, they ended up doing better.
Wow, interesting.
So that shows how old speculation, it was often about the risk of the company itself.
Right.
But today, we see a different kind of speculation.
Use speculation.
Yeah, new speculation, it's all about those future growth expectations.
So like betting on potential.
Exactly, and complex formulas, justifying any price.
Oh, it's fancy formulas.
And just market psychology, forgetting about actual value.
Okay, so those tech companies with crazy valuations, even though they haven't really proven anything yet.
That's a prime example.
That's new speculation.
It is. Let's take IBM, for instance. Back in Graham's day, their price-to-earnings ratio was pretty stable.
Makes sense. They're solid.
Solid, not explosive. But in the last few decades, all these projections of huge future growth, using those complicated mathematical models.
Their value just went through the roof.
It did. And that brings us to growth stock mania.
Overpaying just because a company is supposed to grow fast.
Exactly. Graham warned against relying on those complex calculations, especially when they're based on, shaky assumptions about the future.
Yeah, who knows what'll happen.
And he had a story from his own life to show how dangerous this mindset can be.
Oh, you mean when Graham made a bad investment himself?
He did. As a young investor, he dismissed computing tabulating recording. The company that would later become IBM,
No way.
he thought it was overvalued, too much fluff on their balance sheet.
He missed out on IBM.
He did. It was a wake-up call, He learned that sometimes boring businesses can be super profitable.
And that getting caught up in the hype can be costly.
Very costly. That's a lesson for any investor, especially now with those sky-high valuations we see.
So if we want to avoid that growth stock trap, what should we look for?
Graham believed in focusing on companies that pay and increase dividends.
Dividends. Seriously. Aren't those kind of like old-fashioned?
Well, maybe, but they provide a cushion when the market goes down.
Protection.
Yeah, and they're a tangible return on your investment.
Instead of hoping for future gains, you're getting something now.
You are. And Graham also thought that a company's dividend policy, it said a lot about their management.
What do you mean?
A company that pays dividends consistently and grows them.
They're showing commitment to their shareholders.
They are. They want to give back.
That makes sense. But is dividend investing still a good idea in today's market?
It's a good question. A lot of companies prefer buybacks now.
So how do you see that?
Well, things have changed, that's for sure. But the principle is the same. Are you getting a real return on your investment?
Instead of just chasing potential future gains, you're getting something tangible right now.
That's the idea.
I like that. But even with good dividend payers, the market can be wild.
Oh, yeah, it can be a roller coaster.
How can we stay calm when things get rough?
Well, Graham had this idea of Mr. Market.
Mr. Market. Okay, tell me more.
He imagined the market like a person, kind of manic depressive,
Oh, wow.
who shows up at your door every day, wants to buy or sell your stocks.
At crazy prices.
At prices that have nothing to do with their real worth. Sometimes he's super happy, offers you a ridiculous price.
Okay.
Other times he's down, wants to sell you his shares for pennies.
So instead of getting caught up in his mood swings,
We should see those market changes as opportunities, not threats.
easier said than done, I think.
It is. But Graham's advice was ignore the noise, focus on the long-term value.
That takes discipline.
You need patience, discipline, and then you can use Mr. Market's, craziness to your advantage.
Buy when he's panicking, sell when he's euphoric.
That's it. But that takes a lot of discipline, especially when everyone else is losing their heads.
Yeah, it's hard not to get swept up in that.
It is. And that's where Graham's idea of the margin of safety comes back in, I think.
Oh, right. Buying for less than it's worth.
That margin of safety, it's like a buffer.
A buffer against what?
Against surprises, unforeseen circumstances. Maybe you made a mistake in your analysis.
Everyone makes mistakes.
And of course, those unpredictable swings of Mr. Market.
So it's like a built-in safety net for your investment.
Yeah, like a cushion.
I like that.
Yeah.
But how do you actually figure out that margin of safety today? So much of a company's value is intangible now.
You're right. Future growth expectations, things like that.
How do you know what a company's really worth?
That's the big question, isn't it? And that's why Graham, he really stressed doing your research.
Really digging deep.
Yeah, and being skeptical. Don't just trust those Wall Street analysts or fancy algorithms. You got to look for yourself.
Go beyond the headlines.
Exactly. Understand the company's financials, what their competition is like, and be realistic about the future.
No crystal ball needed.
Right. You're not trying to predict the future. Just understand what the company's worth now.
Makes sense. But even if we do all that, we're still human.
We are, emotions and all.
We can't just shut off our feelings.
Graham knew that. He said the investor's biggest problem,
Their worst enemy.
yeah, is likely to be themselves.
Fear and greed messing things up.
Exactly. We chase hot tips, sell in a panic, forget all our planning.
Logic goes out the window.
It does. So Graham, he wanted us to have a strong investment philosophy.
Like a set of rules to follow?
More like guiding principles to help us through those emotional ups and downs.
So we don't make rash decisions.
Right. A financial compass to keep us on course when the market gets stormy.
I like that analogy. But how do you even develop that philosophy?
Well, it takes time, experience. But Graham, he talked about two types of investors.
Oh, yeah. Defensive and enterprising, right?
You got it. Defensive investors, they're more cautious.
Looking for stability.
They don't want to spend hours analyzing every little thing.
Makes sense.
So Graham recommended for them a simple portfolio.
Stocks and bonds mixed together.
Diversified, that's the key. High-quality stocks, some bonds. He even suggested specific percentages, for different assets.
To manage the risks.
To manage the risk, yeah.
Okay, makes sense. And enterprising investors, they're more active, right?
They are. They're looking for those hidden gems, the undervalued opportunities.
Maybe in more complex areas of the market.
Right, areas that others might overlook. They're willing to put in the time, the effort.
For potentially bigger rewards.
Exactly. So whether you're defensive, looking for steady growth, or enterprising, searching for those diamonds in the rough.
Graham's got something for you.
He does. It all starts with knowing yourself, your risk tolerance, what you want to achieve.
Your goals.
Your goals, yeah. There's no one right way to invest.
No magic formula.
The trick is finding a strategy that fits you, that you can stick with for the long haul.
That's what's so great about Graham's work. It's not just stock tips.
It's not about getting rich quick.
It's a philosophy. A way of thinking about investing.
That's timeless. It goes beyond any market trend.
Cut through the noise, make decisions based on logic, not emotions.
That's it. He shifted the focus from speculation and quick profits to the long term.
Understanding what a business is really worth.
That's so important today with all the hype and speculation out there.
But here's a question. With all these index funds now, is actively picking stocks, like Graham did, is that still a good strategy?
That's a great question. A lot of investors are wondering that.
Index funds are so popular now.
Low cost, broad market exposure, it's appealing.
And some experts say it's impossible to beat the market consistently.
Especially after fees, yeah.
So is active investing dead?
Well, it's true that most active managers, they don't outperform the market in the long run.
The data shows that.
It does. For a lot of people, index funds, they make sense, simple and affordable.
Oh.
But even in the age of indexing, I think Graham's ideas, they're still valuable.
Even if you're not picking individual stocks.
Even then, you still need to decide how to split your investments, how much risk you can handle.
Asset allocation, risk tolerance.
And staying focused on your long-term goals, no matter what the market does.
So Graham's teachings on valuation, risk management, emotional discipline,
They all still apply.
they make you a smarter investor,
A more informed investor, for sure.
even if you're not a stock-picking expert.
That's the beauty of it.
This deep dive has been really eye-opening. I hope our listeners are getting a lot out of it.
Me too, me too.
We've only scratched the surface of Graham's wisdom, but we've uncovered some great takeaways.
To help us all be better investors.
And remember, even with all the changes in the market,
All the new technology.
the principles of value investing, they're still powerful.
Buy businesses for less than they're worth. That's the key.
Absolutely. And speaking of buying businesses for less than they're worth, let's talk about bargain hunting.
One of Graham's favorite strategies.
Finding those hidden gems, even in a market that seems overpriced.
It's exciting, isn't it?
It is. But where do you even start looking for those bargains?
Well, Graham believed that even in an expensive market, there are always undervalued companies.
Pockets of opportunity.
You gotta look for stocks trading at a big discount to their real value.
Like finding a diamond in the rough.
A company with strong fundamentals that the market's ignoring.
But why would a company be undervalued in the first place?
Lots of reasons. Maybe a temporary setback, bad news in the media.
Or just nobody's paying attention?
That happens too. But finding these bargains, it takes work.
You can't just skim the headlines.
You can't. Graham was all about thorough analysis. Going beyond the surface.
Looking at the company's financial statements, understanding their business.
Understanding the why behind that discount.
Is it a temporary problem or a sign of something deeper?
That's the million-dollar question.
And that's where the skill of an enterprising investor comes in.
That's right, being able to see what others miss.
It's like being a financial detective.
Piecing together the clues.
I like that. But even if you find a great bargain, what if the market never catches on?
That's the risk, you're right. Graham knew that the market can be irrational.
For a long time.
Sometimes those bargains stay bargains longer than you'd expect.
You need patience.
And conviction. It's easy to doubt yourself when your investment isn't doing what you thought it would.
You start second guessing.
You do. That's why that investment philosophy we talked about, it's so important.
To keep you on track.
It reminds you to focus on the fundamentals, not the short-term price swings.
Don't get emotional. Stick to the plan.
That's it. It's like having those guiding principles to help you when things get rough.
If it were easy, everyone would be a super investor.
You got that right. And that brings us to another important part of Graham's thinking. Managing risk.
We've talked about the margin of safety, but what else did he recommend?
Well, diversification was big for him. Don't put all your eggs in one basket.
Spread the risk?
Exactly. Invest in different assets, industries, even different countries.
So if one investment goes bad,
It doesn't wipe you out.
what else?
He also didn't like debt, too much debt.
For yourself or the companies you invest in,
Both, yeah. Debt can make losses bigger.
especially when things go wrong.
So, keep your finances flexible, don't overextend yourself.
Good advice. Anything else?
Oh, one more thing. Graham said, invest within your circle of competence.
What does that mean?
Stick to what you know. Don't chase fads, don't invest in things you don't understand.
Stay in your lane.
Exactly. Focus on areas where you have knowledge, where you can really judge a company's worth.
So knowing your limits is important.
It is. And speaking of limits, Graham also talked about learning from mistakes.
Everyone makes them.
Even the best investors. But it's what you learn from those mistakes, that's what matters.
So it's a continuous process.
Of learning and improving, always trying to get better.
And that's what's great about Graham's philosophy. It's not a set of rules.
It's more like a framework.
It can adapt as you learn and grow.
Exactly. It's a journey, not a destination.
Well said. We've covered a lot today, from those super investors to growth stock mania, dividends, emotional discipline.
Margin of safety, bargain hunting.
We've really explored Graham's world.
It's been a great discussion.
I feel like I've learned so much. As we wrap up, I want to leave our listeners with this. Investing, it's a marathon.
Not a sprint.
It's about making smart choices, managing risk, staying focused on your long-term goals.
And never stop learning.
The best investment you can make is in yourself. Keep learning, keep exploring, and keep striving to be a better investor.
Till next time.
Happy investing.
You know, this whole bargain hunting thing, it makes me think of one of Graham's most interesting ideas.
Oh, yeah. Which one?
He said, the market, in the short run, it's a voting machine.
Okay.
But in the long run, it's a weighing machine.
That's a good one. What does that even mean?
So in the short term, stock prices, they go up and down based on all sorts of things.
Like what?
Emotions, speculation, what's in the news, you know.
So it's not always rational?
Not at all. It's like whoever's the most popular wins, even if they're not actually the best.
Just like a popularity contest.
Exactly. But over time, the market, it starts to figure things out.
It sees through the hype.
It weighs the real value of a business, their earnings, their assets, you know, the fundamentals.
So eventually the truth comes out.
It does. And that's where being patient, being disciplined, that really pays off.
You got to wait for the market to catch up.
And that's what a bargain hunter does. They use that short-term craziness to their advantage.
Buy when everyone else is selling.
Buy low, sell high, right? But there's a risk too, isn't there?
What's that?
What if those bargains, they're not really bargains at all?
What do you mean?
What if they're value traps? Companies that are cheap for a reason.
Oh, because they're actually bad businesses.
Exactly. That's why Graham, he said, don't just look for cheap stocks, look for undervalued companies.
Companies with good fundamentals?
Strong balance sheets, consistent earnings, good management.
So they have potential.
They do. He even had specific financial ratios, ways to measure these things.
To help find those hidden gems.
To separate the good from the bad, yeah. It's not just about finding a low price, it's about understanding why the price is low.
Does it make sense?
Is it temporary or is it a sign of bigger problems? That's the key.
It's like detective work, figuring out what's really going on.
That's a good way to put it. You got to be able to see what others miss.
But even then, what if you're right, you find a great bargain, but the market just doesn't agree?
That happens. It definitely happens. It takes conviction to stick with your idea.
Especially when everyone else thinks you're wrong.
It's hard, isn't it? Remember what we said? Our own emotions can be our worst enemy.
We start doubting ourselves.
It's easy to get discouraged when the market doesn't do what you thought it would.
You start thinking, maybe I missed something.
That's why that investment philosophy, those principles, they're so important.
To keep you grounded.
To remind you why you invested in the first place, to stay focused on the long term.
Not get caught up in the day-to-day ups and downs.
Exactly. It's like having a roadmap to guide you through the tough times.
Makes sense. It sounds like a lot to learn, though.
It is, but Graham's book, it really lays it all out for you.
The Intelligent Investor.
It covers everything: psychology, risk management, how to analyze different investments.
So no matter what level you're at,
There's something in there for everyone.
it's a classic for a reason. Well, we've covered a lot of ground today, exploring Graham's world,
From super investors to bargain hunting, it's been quite a journey.
and I hope our listeners, they feel like they've learned something valuable.
Me too, me too.
We talked about buying businesses, not stocks, understanding the difference between price and value,
The importance of a margin of safety, the dangers of speculation.
and those dividends, they're still relevant even in 2025.
We talked about the emotional side of investing.
The need for discipline and patience, having a sound investment philosophy.
And Graham's strategies, they can still work today.
So as we wrap up this deep dive into The Intelligent Investor,
I think the main takeaway is this.
investing is a marathon, not a sprint. It's about making good choices
Managing risk, staying focused on your goals.
and never stop learning.
The best investment you can make is in yourself.
So keep learning, keep exploring, keep striving to be a better investor.
Until next time.
Happy investing.